This is absolutely mind-blowing. President Trump just announced 50-year mortgages to help home affordability for those people that want to buy a home. And while that sounds good on the surface, the thing is, it's actually a terrible idea. We're going to take a look at why everybody's talking about this 50-year mortgage and why you should be extremely careful about getting one. We have over 50 years combined real estate experience here at Kaplan Pro Realty. If you want to know exactly how to take advantage of this mortgage change, then stick around. But before we cover the breakdown of this 50-year loan into 600 easy to understand words, could you do us a favor? Go ahead and subscribe. It's the best investment you can make that won't affect your Social Security. And while you're here, why don't you take out a second mortgage on the like button? As a reward, I'll give you 100 internet points. The standard 30-year mortgage was born in 1940s to help returning soldiers buy homes after World War II. And it worked beautifully. Stability, predictability, and time to build equity. Now fast forward 80 years and the 30-year term is still the gold standard. Most homeowners never even make it to year 30. They move or refinance about after 12 years. And that's fine because that system was built for that cycle. But now the idea of a 50-year loan pushes that system to the extreme. It sounds like affordability, but what it really does is stretches your debt across generations. So let's take a look at some numbers. The average home in Lee, Charlotte, and Collier counties is approximately $400,000. So let's just use that as our number. 15-year loan is about 5.66 interest rate right now. A 30-year loan, about 6.25. A 50-year loan doesn't exist yet, but if it did, we would expect to see a higher interest rate to compensate for the amount of time that investment bankers are tying up their capital. If we make an assumption for half a point for every 15 years, we'll just assume 0.78% increase. So we'll say a 50-year loan would have a loan rate about 7.03%. So that will be our interest rate. So let's run with that. A 15-year loan at 5.66 would have a monthly payment of $3,317. And over the life of the loan, you'd give the bank an additional $197,000 to the original loan amount. A 30-year loan at 6.25% interest would have monthly payments of $2,465 over the life of the loan. You'd give the bank an additional $487,000 in addition to the original loan amount. Hey, wake up. Are you guys still with me? Check this out. A 50-year loan at 7.03% would have a monthly payment of $2,415. And over the life of the loan, you'd give the bank an additional $1,049,565 in addition to the original loan amount. So what's the deal? A 50-year loan would cost more than a 30-year loan in total over the life of the loan. And it only save you about $50 a month. This just doesn't make any sense. What's more, let's just assume for the sake of the argument that our government peacefully unite across the aisle just to mandate that 50-year loans match the 30-year loan interest rate. So let's run the numbers again. A 50-year loan at 6.25% interest rate would have a monthly payment of $2,179. And over the life of the loan, you would still be paying over $1.5 million. Your monthly payment would go from $2,465 a month for a 30-year loan to $2,179 for a 50-year loan. So you're saving a grand total of about $286. That's about 11%. So is $286 a month worth $1 million more in additional interest payments? I don't think so. The average first-time home buyer is 40 years old. So you have millennials that are now in their 40s able to finally be able to afford their first home. And when are they going to be paying this off? When they're 90 years old? This is a banana. But why are 30-year homes so much more popular than 15-year loans if the total cost is so high? That's because a monthly payment for a 30-year home is $852 per month, or a total of approximately 26% cheaper than a 15-year mortgage. And that's why there's a lot of diminishing returns here. And that's part of the reason why 50-year loans make no sense. That's not affordability. That's slow financial erosion. And if you're over 60 or 65, that's not just a number. That's your retirement horizon. Think about it. If you start a 50-year mortgage at 65, you'd be 115 when it's paid off. So who's really paying the loan? Your kids, your state, maybe your grandkids? That's not a legacy. That's a hand-me-down loan. And in a state where roofs, flood insurance, and taxes all increase faster than inflation, you don't want to owe more to the bank than you'll ever live to be able to pay back. What we need is not more debt. We need more smart policies. What we need to do is increase the supply of homes and to decrease the demand. A 50-year loan does neither of those things. So here are 3 things that we can do to increase the supply of homes. Number 1, we can raise the capital gains exclusion tax. The last time we did that was in 1997 when Bill Clinton was in office. Do you remember when he was in office? If we raise the exclusion tax from $500,000 to $1 million, this will encourage more people to sell their homes, which unlocks lower price inventory for new home buyers. The idea to create portable mortgages arose out of the 70s and 80s in the UK when interest rates were extremely volatile. The idea is that homeowners could keep their loans and slightly adjust the amount when they're moving. It would effectively incentivize people who purchased a home loan when interest rates were lower to move up and move out, again, freeing up entry-level homes for first-time buyers. And finally, last thing we can do is streamline the property development process. There's a ton of governmental overhead when developing new properties, and the more we can scale that back, the faster that homes can be built. The other option is to curtail the demand of home. And this topic deserves its own video, so we'll set that aside for another time. Now, I'm not Nostradamus, but I can see how this would get passed into law. Some developers have already said that they're going to implement this, but I think that's more of a gimmick to get you to buy one of their new homes. So what does that mean for your Southwest Florida home? If this idea becomes law, it will lower monthly payments about 10%. So I foresee home prices raising 10% to compensate. Remember, nothing is fundamentally being done here to change the supply or the demand. So prices must go up to compensate. Check out this video here if you want to see how we are an epic buyer's market right now for Southwest. You've spent decades building your wealth, raising families, and planning for this next chapter. Don't let a shiny new loan product steal the freedom that you've earned. The Florida dream isn't about the longest mortgage. It's about the shortest road to peace of mind. I'm David Peterson for Kaplan Pro Realty, and until next time, we'll see you in the sunshine. Thanks for watching.